The B of A flow show today says you've got risk on until bond yields in the U.S. go above 5.1%. You can take a look at the curve. They're not that far away, right? They're not that far away. I mean, you can look at what's happening in other bond markets around the world, but yields have been creeping up of late. There's no doubt about that. Could we show a whole look, guys, aboard of all of the curve? There, yeah, there you go. I mean, you're at 494 on the 30. 440. We'll see what the Fed does next week, too, by the way, and we'll get to that later. But if there's one thing we learned this week, and Steph really hit the nail on the head, is that these companies, Rob, are spending and spending and spending, and they don't really care about the return on the investment today. The question is it going to come tomorrow? Yep. You're buying that dream. You are. You own Microsoft, you're buying that dream. Wedbush, $600 target. They maintain, outperform. Dan Ives calling that stock the Scotty Scheffler of software. For those of you who are not golfers, that guy's good. Okay? He's like, I'm not saying he's Tiger, but he's like crushing everybody these days. So that gives you an indicator, Rob.
We would use, you and I, Scott, the Michael Jordan or Steph Curry of this space. And it's hard to argue that they're not the highest quality technology company in the world. But stock's not cheap. We own it. We are neutral to Microsoft. It's been something that we've episodically trimmed, regrettably. Diversified management, diversified product base, great management team. This is a company that is firing on all cylinders. They will be a beneficiary of everything that is happening, as will Meta, who has arguably been the largest player to be able to monetize AI at this point. So I just think you're going to continue to see enormous cap spending, which supports the semis, the Broadcoms, the Nvidias, all those types of business that I know Steph and I have been investing in and talking about on the show this year. And I don't see any slowdown for that. That said, just to bring it back to the speculative fervor. Okay, just for 1 second.
All right, make it a quick second, because the train has left that station now. We're on to the earnings.
You need to be able to say that forward returns are coming in. You can already see with each earnings beat, there's less and less upside with that beat. And why? It's because of that relative positioning. People are all in, not institutions, individual investors are all in on the speculation. And so forward returns draw back a little bit. I think these businesses, which are a very large part of the market, which drive the market, are firing on all cylinders. So they're not going to be the ones that are completely impacted. You might have ebbs and flows, but this is a long-term story that remains intact.
Okay, that was about 70 quick seconds, but that's neither here nor there. Now we're going to move. We're going to talk about Meta because of the spend, Steph. The CapEx guide is 64 to 72 billion. That's up 83% year on year. Those numbers don't mean much to people other than, wow, that's big. And they continue to grow. And you don't care as the shareholder. I had someone say this week, I think maybe it was Ives, who said the spending's actually bullish, not a negative on any of these companies. Do you feel that way?
Yeah, it's going to fuel future growth, absolutely. By the way, $70 billion if they spend this year, their free cash flow is $34 billion after that, right? So they have so much free cash flow, and they have monetized AI. AI in ads has increased 7% time spent at Facebook and 6% time spent at Instagram. And price per ad is up 10%. So I expect to see very strong results there, improving results. I like that he's being really aggressive on buying people and getting more talent in.
Zuckerberg?
Yeah, I do. I really like that a lot. So I think they're going to be I think the quarter's going to be great. The biggest question is the overall expense guide, right? That's the thing. We don't want that to go higher in terms of the OPEX piece. So that's the thing I'm going to be watching. But I think this is going to be great. I really do. And I don't think it's expensive at 18 times EBITDA. It trades in line with its historical average.
How do we feel about Amazon, which got maintained buy today, 265? Mones Crespi and Hart. Everybody on the desk, like Mr. Snipe, owns this name. Are we optimistic going in?
So I think as it relates to Amazon, for the couple of things for me. One, the consumer has obviously hung in there, which I think is a unique positive for them. Prime Day, which is not Prime Day anymore, it's Prime Week, will not be in the numbers, but it was positive, and I think that's a good number for the stock going forward.
Yeah, I know, but you're talking about things that are not at the heart of what this company thinks it's going to buy. I know, but you're burying the lead. Everybody wants to know where AWS growth is. What are you willing to pay for the whatever level of growth that AWS is going to be? That's the whole story.
It is the whole story, and it's the largest player in the marketplace, obviously, on cloud. It was up 17% last quarter. I think you'll see a similar number. It's a $120 billion business, right? So, and you're seeing, I mean, Google Cloud was up a lot. Azure was up a lot. I think this is the #1 player in the game, and I think you'll see continued growth here.
You can talk about them from a marketplace standpoint, but they'll tell you, well, we want to be what we were in retail to AI.
Yeah.
They want to be an AI marketplace.
Look, Amazon Web Services is very big. I think we have to be realistic that the growth rate in Amazon Web Services a year or 2 years ago may not be the same today simply because it's bigger. That doesn't mean that it's doing poorly.
Yep.
I mean, one of the things that worked with Alphabet this week is that their Google Web Services is smaller, so the growth rates look bigger. I by no means am throwing shade at Amazon. I think it's going to be a very good quarter. I actually wouldn't give, I wouldn't pass on the idea that the overall consumer business actually powers them as well. And I'm happy that we're not talking about that.
Yeah, no, but you're not going to pay, you're not paying the multiple you're paying for the consumer business. As that multiple gets bigger.
This is a good discussion. I don't think it's as expensive as we used to talk about Amazon.
I didn't say it's expensive. I didn't say it's expensive. You're not paying 29 times for buying your shaving cream on Amazon.
Here's what I'm saying to you is I get your point. I do. I think actually that maybe the consumer business is underrepresented.
It's 37 times forward, by the way.
But it's 14 times EBITDA versus 18 times historical. And I would argue North America, maybe you don't want to pay that kind of a multiple just for that, but the profitability is improving. You're going to see margins improve in North America to be about 6.5%. That's what people want. They want them to be more profitable. And AWS, they had supply chain issues in the last couple of quarters, and they're actually going to lapse those, and that actually is a very easy comparison. So I actually think there's a chance you could see an acceleration in AWS.
A simple story. It's a story of operational leverage, which you talked about, and exposure to 2 secular growth areas. That's the story. And the operational leverage that comes from everything that Steph's talking about is what investors are going to pay attention to. Do you get operating leverage from your business as you continue to scale? And they are getting more efficient, no question.
The bar, maybe for everybody, is high. I don't know how high the bar is for Apple at this point coming into this particular quarter because these particular numbers. Well, because we're waiting for more action, if you want to use that word, on what their AI strategy truly is going to look like. Needham is cautious into the earnings. They must articulate a Gen AI action plan, says Needham. Jim, Jason, Rob, you own the stock. Jim?
I'll just make this quick. I talked about pretty pictures in the start of this A block, but I'll tell you what, the picture of earnings revisions for Apple is not a pretty picture. They need to turn it around. I mean, in the proverbial sense, they need to pull a rabbit out of the hat. Was that Dan Ives you were just quoting? Whoever you were quoting, that's exactly right. They need to pull something out of the hat with regards to generative AI and get these earnings revisions going higher. They're going down right now. That needs to turn around at the multiple that we see on Apple.
Are we optimistic now? What's the story here?
It's a name that we're underweight right now. We trimmed it earlier this year because of a premium valuation relative to their growth rate, a lackluster product refresh cycle, and the fact that, that we own it at all is because the gains we have and the management team is hard to bet against, really hard to bet against.
Okay.